All right. We're going to begin, so if we could get our first panel up here. I just have a few opening remarks, and then we'll get right into the program today. All right, then. Good afternoon, everyone. Welcome to the inaugural session of the Growth Capital Summit, a legal and regulatory briefing on issues impacting emerging growth company finance and investment. My name is Brett Getches. I'm the editor and publisher of Growth Capital Investor, the Journal of Emerging Growth Company Finance, and your host this afternoon. All right. David, I'll let you take it away.
Brett. Thanks for coming out today, and we appreciate the opportunity to talk to you about these issues. This panel, I think, is a little bit broader in the sense that we're going to look at both Title II and Title III and sort of crowdfunding writ large in terms of both of those provisions and how they've played out in the years since the Jobs Act was enacted. And in a way, I think of it as kind of a tale of two cities here between Title II and Title III. In Title II, we had the SEC basically deregulating offers as they were directed to in the Jobs Act, and sort of as the give up for that, we had to institute accredited investor verification. And, that was a major change, as Brett said. That was a huge change to the federal securities laws to deregulate offers and allow general solicitation, general advertising, and 506, Section 482 offerings. So that was a very significant change, and we actually had the SEC act on that direction and adopt rules back in the summer of last year, and had them go into effect and had them in effect. And then at the same time, Title III, which provides for essentially crowdfunding to anybody, not limited in terms of investor, but only by terms of the investment amount itself. And Title III has sort of hit a speed bump here and hasn't gotten past it, in that the SEC has proposed rules, and we have proposals that were well thought out and tried to implement the statute, but yet nothing has happened to adopt them despite the congressionally mandated deadline that they were told to meet. So at that end of the market, sort of the more unlimited crowdfunding, not accredited investor crowdfunding, the developments have been, slow to see because there really hasn't been any regulatory movement. And in its place, I think a lot of focus has been on how the use of general solicitation in connection with Reg D Rule 506 offerings can be used to sort of do the type of crowdfunding that a lot of people were hoping could be achieved, as long as you could do it to accredited investors that can be verified. So we have sort of a one side of the equation where nothing has really transpired other than a proposal, and we don't really have any visibility into when that crowdfunding set of rulemaking will go through, and even when it goes through, to what extent people will find it useful for capital raising purposes. And at the other side, we have something that has been implemented subject to somewhat of a cloud, and we'll talk about that, I think, to some extent here, in terms of the fact that the SEC, when it adopted these rules, also proposed additional changes to Form D and the information that had to be filed on Form D, when you had to file Form D, including filing an advanced Form D and a closing Form D, as well as disclaimers on general solicitation information, all designed to enhance investor protection around Rule 506C, or general solicited private offerings. And sort of that aspect of that rulemaking, and that it was proposed but yet never adopted, has worried a lot of people, and I think some people have found it to be a drag on the overall implementation of 506C. So against that regulatory backdrop, I think I'll turn it over to Chris to tell us a little bit about what he's observed in the marketplace in 506 land.
Sure, thanks. So I operate a platform called OfferBoard. that executes both 506C and 506B transactions. Our holding company owns a broker-dealer, and so we're operating under the broker-dealer rubric that's required of people who are facilitating Title II transactions. And what we are happy to announce today is that we're releasing on our website at offerboard.com a white paper that we've produced on data from the first year of Title II crowdfunding. And so I'm going to go through just a few highlights of that data. Some of the things are counterintuitive. I'm going to do a little tea leaf reading, which I welcome the other panelists to argue about, and then we'll see where we end up. So what you would expect, I guess, if you were trying to liberate capital for newer, smaller companies is that the average raise size over the last year would have gone down a little bit, and you would be right. The average raise size went down from $1.5 million to $1.2 million, and you'd expect the number of raises to go up, and that would happen as well. That you would be right about that as well. The amount the number of raises went up by 24%. What you would also expect, but didn't happen, is that the total amount of money raised would go up. And the total amount of money raised last year, from September 2013 to September 2014 versus the year prior, actually went down a little bit. And so that reduction went from about 800 billion sold to about 700 billion sold in the overall Reg D marketplace. You would also expect the number of unaccredited investors that participate in deals to go down, and you would be right. The number of unaccredited investors went down from 10% to 7%, which is presumably because in a publicly advertised raise, you can't have any unaccredited investors, and so that prohibition would have changed a little bit. And you would expect the overall number of investors to go up because you would expect to have attracted potentially people who are investing slightly smaller amounts of money. You would also be right. I think you wouldn't guess that it would go up 50%, and I'm sure there are other things other than just Title II of the Jobs Act affecting all of this data, but the number of investors in private placements went up by 50% last year over the year prior. And then finally, you might expect in a world that's new for more people to go out and use an intermediary to facilitate their raise. And unfortunately for our business, you would be wrong. The number of people who used an intermediary to facilitate their Reg D raise stayed the same at about 12%. And so there's a lot of interesting data there. There are a lot of things I guess we could talk about. Again, our report at offerboard.com. Just click on resources. It goes into greater depth on all of this data and presents various charts and graphs that you're free. We welcome commentary. Would love to hear from people.
I'm hearing it. I think it points to a couple of things. One thing is there is a dearth of data on this market. We could really use more data. I'm really glad you did this, Chris. It's really very helpful. One thing that seems to be that everyone on both sides of the political aisle and all sides of these arguments is that there's just not enough information out here. Particularly with respect to, and hopefully I think we're going to get to it later, which is relevant to Title II, is the definition of accredited investor. People are suggesting solutions for problems we are not sure exist because we don't have the data to support that there's a problem that needs to be fixed. So I'm awfully glad that there's at least some data, and I would like to request that to the extent that it's possible that everybody should, certainly that would be one thing that I would like to see the SEC do, is actually get just more data out there so that we can actually look at and see how many people are here, right? For example, what percentage of the individual investors are barely above the $200,000 threshold? My anecdotal experience is that there are very few people making $220,000 a year that are actually participating in the market. Most of them are much higher. So with raising the threshold, if we have to do that, first of all, it sounds like the market is probably already fixing that. There's no reason to do it. But if we did, it may have a nominal effect on anything. But we don't know because we haven't asked, because we don't have the data. So thanks for doing that. That's good. it's good. But we don't.
One thing about the whole, using the SEC data, though, I think that we have this whole dark market out there, which is angel investing. When you look at the University of New Hampshire numbers that they keep, they're talking about something like 67,000 transactions a year. And it's hard to equate what's going on apparently in the angel community with what's being reported to the SEC. Now, the angels typically say, we don't file Reg D with the commission. But what we're going to lose by not being able to compare these two piles of data is the extent to which the ability to do stuff online is pulling information from the, pulling deals from the angel community. So that's one of the biggest gaps, I think, in all of the data that we have is we've got the good stuff from the SEC, which is being brilliantly and beautifully arranged by Offerboard, and then we've got the University of New Hampshire stuff there. We don't know. We know there's an overlap. We don't know how much it overlaps. And then, of course, let's set aside the whole 144A market because that one doesn't show up in those numbers either. But maybe that's not such an issue for startups, obviously.
This panel is going to address Title III and Title IV of the Jobs Act. We spent some time on Title III in the previous panel. I believe most of this panel is going to focus on Title IV. Moderating this panel today is Sam Gusick with Gusick & Associates.
I want to thank Brett for having this conference and taking the initiative. I think it's really important, which is why I wanted to be part of the sponsorship here. I don't think enough is being done on behalf of small business. I don't think that's news to anyone. I decided to start my morning today by going over to Capitol Hill and speaking with some folks, and I just happened to run into a gentleman whose name and face you've probably seen. His name is Frank Luntz. He's a pretty nationally widely known pollster, and I walked over and I introduced myself and said I'm a securities lawyer from Southern California, and I'm here to talk about small business capital formation. I said, you know, there's not enough people in this town talking about small business. And there was a pause, and then he said, there is nobody in this town speaking up for small business. So while that's maybe a little bit of an understatement, there's a gentleman there who I think has got his finger on the pulse of not only Washington, but public opinion. And on that note, I just want to refer everyone to a press release that was put out this morning by the chair of the House Financial Services Committee, by Jeb Hensarling, speaking directly to the SEC and the forum tomorrow. I think you ought to take a look at it. It's in today's Crowdfund Insider. They picked it up, but I think it's worth noting. Let's move on to what hopefully people are interested in, which is Regulation A+. I personally am very excited about it. I first spoke at a conference back in April that Brett put together, and I wrote an article, and the article was entitled Regulation A+, Sleeping Giant for Small Business, with a question mark at the end of the title. There's no question in 2012, when the Jobs Act was passed, regulation that Title IV was asleep. And I say that because it was the only provision in the Jobs Act which was not only not self-implementing but required rulemaking, but also had no deadline for rulemaking by the FCC. And the smart money at the time was betting that we'd never see rules. So it was asleep. Why a question mark about being a sleeping giant? I think for a couple of reasons. I mean, I think mainly Regulation A+ has the potential to fill a very important void, which is basically the deterioration or inactivity in the small IPO market since the late 1990s. And number two, it comes at the intersection of something else which I think we're going to be hearing a lot about, which is venture exchanges. And the reason I think we're going to be hearing a lot about that is simply because, number one, it's needed. Number two, it's tied into Regulation A+, according to Commissioner Gallagher and others. And because the venture exchange issue is probably Commissioner Gallagher's #1 issue, we're going to be getting a push in that direction, both at the SEC, but I think also, more importantly, by Congress. So I think the two coming together, and they are definitely tied together, we can expect this market to be big. How quickly, that's another matter. I can tell you this morning I was in Congressman Duffy's office speaking to one of his staffers, and she told me that who's coming in this afternoon to give them a briefing? Commissioner Gallagher. What's the briefing on? Venture exchanges. Anyway, let me just start off and get down to the meat of things. I'm going to give a brief overview on Reg A Plus and the history of Reg A. Then we're going to do a Q&A and on the panel, and then we'll take questions from the audience. Essentially, Regulation A has been around since the 1930s. As most of you know, it was hardly used. Up until recently, it's had a $5 million cap. It required, essentially, it was a registration process, a short-form registration with the SEC. It had what they call testing the waters provisions, which means you could go out and solicit interest before you actually filed your registration, and paid accountants and paid attorneys. So that was a big feature, especially for small businesses that were more cost sensitive. As far as disclosure, it had an optional Q&A disclosure format. It's intended to make it simpler. It also had no ongoing reporting whatsoever after the initial filing and registration. Unaccredited investors could participate freely. There were no restrictions on that at least under federal law. And most importantly, or certainly importantly, the securities that were issued were free trading. So you had a liquid market, and I think that's the principal distinguisher between Title II and Title IV. The reason it's been infrequently used is because you still had to go through a state-by-state blue sky review. So then in 2012, Congress enacted Title IV of the Jobs Act, called the Small Company Capital Formation Act. Has an initial ceiling of $50 million with the directive to the SEC to revisit that. Commissioner Gallagher has called for that to be raised to 75 or 100 million. It has a blue sky exemption throughout the 50 states, basically preempting authority for two types of securities. One is securities which are sold on a national securities exchange, and the other being for securities sold to what's called a qualified purchaser, and left that definition to the SEC. It required audited financial statements for the offering itself, continued the testing the waters provision, and it provided for ongoing disclosure, including audited financial statements, and left the disclosure to SEC rulemaking. And as I mentioned, there was no deadline for SEC rulemaking. In December of 2013, the SEC came out with its rules. And basically, in the proposed rules, they created two tiers, Tier 1 and Tier 2. Tier 1 is basically the old Regulation A. There was really no statutory authority to do anything with what I'll call the old Regulation A, but they made a couple of tweaks to it. They provided, and these are proposed rules, EDGAR filings instead of paper filings. They eliminated the optional question and answer disclosure format. Otherwise, it was the same, including no blue sky preemption. So it's pretty much still mostly a dead space. And then they created the Tier 2, which is the real Title IV Jobs Act exemption. In the proposed rules, it provided, again, for financial statements with the filing, it had to more detailed registration statement type disclosure, not as complex as a full-blown S1, and then it provided for specific ongoing disclosure, basically what I'll call a 10K light. And instead of doing 3 10Qs, there was one semi-annual report. And then there's a provision for interim 8K type reports for certain denominated events. Now, the real surprise with the proposed rules was the definition of qualified purchaser. The SEC in the proposed rules said anyone can be a qualified purchaser. whether you're accredited or unaccredited, you're smart, you're stupid, it makes no difference. But everyone, including accredited investors, were limited to how much they could invest, being the greater of 10% of their income or their net worth, exclusive of their principal residence. So those are what the proposed rules look like. And now what I'd like to do is just go through some questions here and throw them out to our panel, hopefully flesh out some issues, and then take questions at the end if we could. Okay, I'm going to throw this out to everyone, but I'm going to start with Georgia here down in the end so she doesn't fall asleep from my introduction. If you could just tell us how you think Regulation A+ compares to other types of exemptions or other types of things that are not necessarily exemptions but competing methods. So we're talking maybe Title II, we're talking reverse mergers. Why don't you take a shot at that, and we'll get some other views here.
Sure. So thank you, Sam, and great recap there. So, the first thing I tell my clients when they're looking to raise capital is to really think about first what their existing network is like and where they can source capital from, and then the amount of capital that they're trying to raise. So really that's creating the distinguishing features of Title II versus Title III versus Title IV versus, doing a full-blown IPO, doing a reverse merger. So you have to look at those characteristics of your company, the stage of growth you're in, what you need, and how, what avenues, what potential investors you have out there. Comparing Title IV and Title II and existing, Reg D, anytime you can fill your book under Reg D and, do a private offering, you should do it. There's no reason to go through a full filing process and all of the reporting if you can access the capital that you need targeting accredited investors. However, that's not, a viable alternative for a lot of companies, so they have to go down another avenue. The distinguishing, benefit for Title IV is that you have these freely tradable securities, and that will separate it from a private placement. However, in the private placement market, the holding period has been reduced so much, by such a scale as it stands now, that I don't think the, illiquidity is really so much of an issue. Compared to Title III, obviously, it's better to have, your cap higher so that if you need to raise more capital than, $1 million, that's going to be a real sticking point. But you can access, retail investors under Title III and Title IV. So it really just depends on, the amount of capital that you need at that stage. There's a lot of course, the nitpicky little rules that I'm sure we'll get into and distinguishing characteristics. But, and then of course, doing the full-blown IPO, well, you get the legitimacy of doing an IPO and becoming a public reporting company, but also that's a huge burden. And so for a lot of small and startup companies, they're just not able to undergo those types of requirements. So you really just have to, again, it's a balancing act. You have to look at the company, what stage they're in, what their needs are. Even the reverse merger market that Sam mentioned, there used to be quite a stigma about doing a reverse merger. I think a lot of that's wearing off, and to the extent you can find a clean shell and a good target, and that's the avenue that is appropriate for your company, that's an option too.
Yeah, let me just throw this out to Alex. I know she's had some experience with reverse mergers.
Yeah.
I hope so. I mean, that's my understanding. You've had quite some experience.
I'm doing 5 right now.
Right, exactly. So how do you see Title IV comparing to a reverse merger? If a client comes to you and they said, look, I've got this really great clean shell, I want to do a reverse merger, but there's this thing called Title IV, Reg A+, what would you tell them?
Okay, so my bread and butter practice is basically transaction oriented. So currently I'm taking 6 companies public. 5 of them are by reverse mergers, all in Canada. Only one's an IPO, just because it's quicker, easier, cleaner, faster, and people have certainty. That's what people want. Going back to, why would you say use 506 versus Reg A+? One simple reason, the way Reg A today is, you would use 506 because I don't have to go to the states. Like 506 preempts state regulation, and that's a hands down why you would use that versus Reg A. If we can trump using Reg A plus, doing kind of that state by state getting approval, I think Reg A plus slam dunk becomes a winner for certain types of companies. And why that versus the other? There's a number of different advantages on the RTO side. So the RTO side, all of my deals are funded. They're totally funded. They're different sizes. So the size ranges from a small company that's basically raising $500,000 to list in Canada to a company that's worth about, they've got $260 million in assets, and they're doing a small raise of $5 million. So they want to be public for a different reason, and all their other kind of money is coming from outside sources, but they're going to do a small raise just to kind of increase the pool of retail investors in that deal. So there's different ways of doing it. I can do a reverse merger in Canada anywhere from 4 weeks to 8 weeks on average, which is pretty good. You know, if you're looking to kind of get money. 60% of the companies listed on the TSX Venture Exchange have a market capitalization of under $5 million. 93% on that exchange have a market capitalization under $250 million. So we really are kind of a crowdfunding type market to begin with on the venture exchange.
Okay. I'm just, and I'll let Mark chime in a second, but you can see that Alex likes reverse mergers. I have nothing against them. I've had some great clients that have come out of reverse mergers, gone to NASDAQ, so I'm not in the crowd that doesn't like them. I think that this reverse mergers will always be there. There's always a place for them, but I think Reg A Plus is going to offer a very attractive alternative for a couple of reasons. One is, you're not getting married to a shell, and these shells typically have no real shareholders. You're doing a Reg A plus, and if you're doing it right and you have a company that's really worth financing, you'll actually wind up with real shareholders. And I think there's something to be said starting out that way. The other thing is what we're going to start seeing shaping up is real exchanges that are going to come up to meet the Reg A plus market. And I think that's going to give more legitimacy to companies than having what's still considered some taint by coming out of a reverse merger. Mark, do you have anything to add?
Well, I will add that I think generally Reg A plus is going to be huge. That is my expectation. I think it's going to be gigantic. I actually think that the issue with Reg A plus in the early periods is there are going to be so many filings. The SEC is not going to be able to handle them all in a timely fashion, and we could be waiting quite a long time after you file. I think that with all the clever people that there are in the crowdfunding space, this panel excluded, but with all the clever people in this space, people are going to find ways to drive costs down. It's all going to become more and more automated. So I think the cost of Reg A filings is going to come down. I can see in terms of, combining offerings, I could see a company doing and planning to do a Title II offering to accredited investors first. And while that offering is underway, putting together their offering statement. So you maximize the amount raised from accredited investors in the Title II offering, and then go to the non-accredited because you don't want to limit them to 10%. So I can definitely see those offerings being piggybacked.
Okay, so let me ask you, Mike.
Today, before our special presentation by David Burton, is on the challenges for public emerging growth companies. While most of the day has been spent on Jobs Act-related issues, there's certainly a number of other issues challenging emerging growth companies that the SEC is addressing at this time, or should address in the belief of a lot of us. So without further ado, I will introduce Anna Pinedo and the following panel and let her do the introductions. Anna?
Sure. So we're going to try and stay on time, and we're going to cover a broad group of topics. I'm Anna Pinedo, a partner at Morrison & Forster. I'll let Ellie and David introduce themselves briefly, and then we'll get going first with some enforcement issues, and then we'll go into some capital raising issues for existing public companies that are small cap, mid cap companies.
I'm Ellie Klein, partner at Schulte Roth & Zabel in New York, working on alternative investment structures and regulatory and compliance matters.
I'm David Sergnano. I'm a partner in Morgan, Lewis & Bockius here in Washington. I do corporate securities work. Started my career in the SEC, spent about 20 years there. Been in private practice about 15 years, doing transactional work and regulatory work.
Okay, so as various panelists mentioned before, one of the concerns that arose in conjunction with passing the Jobs Act and with the SEC's promulgation of regulations relating to Rule 506 and crowdfunding and Reg A Plus has been a heightened concern on the part of NASA and on the part of FINRA regarding investor protection issues. And so what we've seen from FINRA and from the SEC's Office of Compliance Inspections and Examinations has been an intense focus on private placements, the practices that are being used in private placements, the role of intermediaries participating in private offerings. And we're also seeing that the SEC is turning to addressing violations in a range of areas. And Ellie's going to talk about Reg M and Section 16, and then we'll come back to microcap and broker-dealer transactions and restricted securities. So, Ellie?
So I think this is just a good example of how the SEC is giving greater scrutiny under the broken windows policy or approach to a bunch of regulations that they had paid either different attention or little attention to. And I'm going to go through two examples because they're at the forefront. They affect a lot of people, investors in particular, and obviously on the flip side of affecting investors, it affects the ability of companies to raise money when the investors are having problems doing their investments, consequences of the investments, and the like. Two things to mention are Rule 105 Reg M, where the SEC has been doing enforcement, and the Section 13 and 16 areas. Rule 105 of Reg M is a rule that states that to the extent that any purchaser who wants to participate in a firm commitment underwritten offering has shorted the stock, entered into a short sale of the stock during the 5 trading days prior to pricing. There's some exceptions to everything I'm saying, but this is a general rule. They're prohibited under the current rule since 2008 from being able to participate in the offering. That means for companies where you may want to be going to investors who have interest in a stock and therefore are trading the stock, both purchasing and selling. Sometimes they're shorting because they're selling off a box position. Sometimes they're actually shorting because they're entering into a short sale. But active investors, and you wanted to put up a shelf, well, David's going to talk about that a little bit later. You put up a shelf, you want to do a takedown off of it. If you're going to do a firm commitment offering and that investor has been in your stock in the 5 days prior to pricing, they're not allowed to do this. The SEC had a history of bringing different types of enforcement actions over the years. They continued to modify this rule until its current form to make it simpler to police. Having said that, it's simpler to police in the sense that if you're short, you just can't participate, and it's made it relatively straightforward. Having said that, they didn't have a lot of actions for a while. Until about a year ago, they came down with a host of enforcement actions at the same time before the end of their enforcement year, calendar year, and they did 23 different investment firms were sanctioned for violating this rule. And there were penalties and there's publicity that was negative, although with 23 maybe the negativity of it is a bit muted. But they definitely came after people and caused people to have to pay more attention to this rule. And again, the flip side for issuers is investors are more careful about this rule and paying attention to it, it may have consequences in their ability to participate in certain offerings, and we have seen that where investors want to participate in offerings but are blocked from being able to do it because of the implications of this rule. They recently as well, for the second time, had another host of actions a few months ago where they again came down and showed that they will continue to police this area. In one sense, it is low-hanging fruit because if they can identify through certain algorithms that they are using now to look at things, if they can identify violations, it's a good way for them to put pressure on people, not just, and this is really the theme of what I want to get through to people, not just in this particular regulation, but puts people on edge about paying attention to the broader market, a lot of regulations, being conservative, and that can cause problems for capital raising. So the 105 area is an area where they have gone after people and undoubtedly will continue to go after people on a regular basis. The second area where we've seen just recently in the last few months action where we had seen very little, particularly the way they did it, almost none for a decade or more, is in the Section 13 and 16 space. Section 13 and 16 are reporting regimes for the most part where if you are an investor or a group of investors that has beneficial ownership of more than 5% or 10% of a stock of a company, you're required to do filings under Section 13, 13G, 13D, and if you cross 10%, you also have to enter, for the most part, Section 16 land. On top of that, officers and directors, executive officers and all directors of public companies are automatically part of Section 16 regardless of their ownership. Section 16 has really two main components to it, the reporting requirement and the profit disgorgement requirement. Most investors, officers and directors are very sensitive to the profit disgorgement rule, which says that to the extent you buy and sell stock within 6 months, you have to disgorge the profit made, the way they calculate it, even if you didn't make profit, back to the company. So it's a pretty egregious statute in terms of the consequence of crossing it. The SEC doesn't police that part, that 16B part. The SEC polices the reporting part, 16A. And again, this is an area where they didn't pay a lot of attention other than in connection with other actions. They threw this type of violation in both the Section 13 and 16 side. But now they came with a slew of, if I remember, 34 different people that they nailed. And the people were really in three categories: company insiders, officers, and directors, investment houses, so to speak, and investors, who were the three categories of people that got nailed for violating the rule, not reporting on a timely basis. The consequence, again, is bad publicity for the most part and a penalty, although the penalties here weren't that much. I guess it depends how much you have at stake. I think from $25,000 to $150,000 were the penalties that they imposed. But having said that, the costs involved were far more extensive in terms of dealing with the SEC and the like. So really the takeaway from this part is that these are two specific examples of how the SEC is much more, as part of the broken windows approach, looking at statutes, going after people, and making life difficult, which has a consequence for investors and on the flip side for companies as well.
In the same vein, the SEC has put out a series of investor alerts recently, as well as educational pieces. And so the ones that are most relevant for our discussion are those on microcap and internet-based fraud or other schemes. That was most recently updated. It had been put out a couple of months ago. It was updated on November 12th. And what the SEC is concerned about and watching for are using websites and broad-based internet platforms to pump up the price of securities, restricted securities that are being sold through internet-based offerings. And so there are several practices there that the SEC highlights in its alert. At the same, more or less the same time, again, a couple of weeks ago, the SEC put out guidance for broker-dealers, making certain that broker-dealers are paying attention to requests from their customers to transfer restricted securities. And again, here, what the SEC and FINRA have been focused on are, to the extent that broker-dealers are being used to sort of facilitate for small-cap public companies that have done private placements, or for private companies using broker-dealers to sort of get restricted legends lifted improperly in transactions. And so a number of enforcement and regulatory priorities where the SEC and FINRA both have demonstrated that they're being very attentive to small cap companies, being very attentive to the practices of portals in conjunction with participating in private placements for either private companies or smaller public companies that have to rely on private offerings as a means of raising capital. So to transition to David's discussion, smaller public companies and micro cap companies, as well as some mid cap companies that are thinly traded, often have a limited array of capital raising strategies. And traditionally, the SEC Forum, the Government Small Business Forum, has focused on some of the initiatives or changes that the SEC could make that would help small cap and mid cap companies. So I'm going to ask David to talk about some of the most important ones.
I'll have public companies, and I might slip back into some private company issues as well because they overlap, as also the ability of these companies to raise capital, focusing on the type of issues that the forum has addressed in the past and may address this year. I'd like to start with 144. I think with this audience, most of you know very much what that's all about. But essentially permits public resales of privately placed securities as well as securities held by controlled persons or affiliates of the issuer. 144 was amended in 2007, became effective in 2008, and made very significant improvements in the rule. For example, it lowered the holding periods from 2 years to either 6 months or 1 year, depending on whether it's a reporting company. Totally removed the obligation of non-affiliate persons selling restricted securities to have to comply with the more onerous requirements of the rule, like volume limitations, manner of sale requirements, following the Form 144. If you're non-affiliate, all you have to worry about is the holding period. And so there's generally a very well done rulemaking. Thank you, Jerry. It did have one quirk in it, this provision called 144I. 144I addresses use of 144 by holders of securities that were issued by a company that it was either a shell company or sometime in its past before that issuance was a shell company. This got into 144 as a culmination of efforts by the SEC to address the reverse merger shell company abuses that had raised concerns. One of the more blunt shots at that was the so-called worm letter. It was a letter by the SEC staff to the staff of the NASD at that time. And whenever you have two regulators writing each other about interpreting their rules, you know there's trouble. But essentially said that...
It's usually a great read.
Essentially said that holders of a shell company before the reverse merger, they'll be considered the promoters of that shell company. When they sell control of that shell company to the operating company and essentially shell control, they can't go out and start selling their securities into the public market at that point on the theory that they're no longer affiliates. We no longer control this. It's free stock. We can now sell it. We've held it for many years. The worm letter essentially said that these promoters are per se underwriters, and underwriters are not allowed to use 144, although 144's purpose is to tell you when you're an underwriter. And so that was a very blunt instrument, and I view 144I as kind of a codification but a refinement of that approach. But it causes problems. You could have a company that's been up and running as an operating company for many years, good citizen in terms of making timely and fulsome disclosure, but there's also always this cloud overhanging it that someday, if it misses a cue, that all the holders of people who bought their securities in private placements will now be prohibited from reselling those securities because that they're subject to a new 1-year cooling off period. The prohibition of 144I is that if you have one of the securities that were issued by a shell company or a company prior to issuance was a shell company, you could only resell under 144 if the company has been an operating company with full SEC disclosure, the so-called Form 10 disclosure out there for 1 year, and has been current for 1 year. Anytime it slips out of that status, anytime it becomes delinquent, there's another blackout period, and that can be very draconian. Even if it doesn't become delinquent, it causes problems because it's most people, when they've purchased in a private placement, held for the requisite holding period and want to resell, they're not affiliates, they can get the legend removed from their restricted securities, they can get the securities entered into the book entry system, and really, and that greatly facilitates the ability to make ordinary way sales in those securities. Issuers will not allow that if they're subject to the 144I restriction, because at any time, the blackout could slip back in if they miss a queue, and you'll be prohibited from selling. But if they take the legend off your certificates, they can't prevent you from selling. So that's a real problem.
And it can really affect the issuers in terms of particularly smaller issuers, the ability to raise capital at a good price. If you have this rule hanging over your heads, investors are going to want reg rights, which they have moved away from quite a bit, and they're going to look for different pricing. So there have been particularly small issues affected by this.
Yes. There have been, approaches to the SEC to get it refined, and the staff has not been that receptive. There are, the forum's proposal is after a 2-year period to cut off the operation of 144I and treat those companies just like any other operating company.
So what do you think? It's going to go through?
I mean, that's something the SEC could do itself. It doesn't need legislation at all to do that. I think they've had some experience with 144I now. I think
Isn't the concern that they've just been non-receptive, maybe because they have more important things, admittedly, but they just
Right.
haven't done anything. Everyone was screaming about it from the day it magically showed up in the rule unannounced, and they haven't been beautiful letter writing and some passionate speech has been made, but I don't think anyone's actually done anything where they put it on enough of the agenda.
It doesn't seem like the SEC has been very amenable. There are other changes that got made to 144, which are big problems for newly public companies very often. For example, a newly public company that was PE-backed or VC-backed, you have to aggregate the sales by, to the extent that the VC fund or the PE fund made distributions to limiteds, the sales by all of those entities have to be aggregated as Rule 144 is currently written. And there were some efforts made earlier this year to have the SEC revisit that, which doesn't pose any of the sort of larger regulatory issues that perhaps shell companies, SPACs, et cetera, might pose. And the SEC has not been very flexible. But I hope that changes to 144 will remain on the small business recommendations or advice coming out of tomorrow's session.
Okay.
So maybe we should turn to 4A1.5?
Yeah, I guess another problem with 144 is it doesn't work very well in the private market, even though it purports to apply to private company securities. One reason is it has the current information requirement, and it refers you to the 15C211 provisions that broker-dealers have to apply when seeking permission to make a market. But it's hard for an investor to say that information is publicly available. And also, the issuers don't want to give all that information out if they're truly private. And also, if it's just an OTC stock and there's really not an active market out there, the manner of sale requirements, particularly for affiliates that apply to affiliates, just don't really work because you need to have more active selling efforts in order to make a sale. So it's not that widely used in the private markets. The so-called 4.1.5 exemption is something that is helpful and looked to. Generally, if you open the 33 Act, you won't find a provision called Section 4.1.5. The notion is that if an issuer could, in the context of this offering, sell to this investor, why couldn't a shareholder sell to that investor, an affiliate sell to that investor in a private resale transaction? So you can think of a 4.1.5 transaction as being the equivalent resale transaction to a private offering by an issuer. The SEC has recognized the validity of that concept for many, many years. The courts have recognized it. Rule 144 Cap A is a codification of that concept, but it's limited to large institutional purchasers, QIBs, and imposes certain informational requirements that some companies don't want to deal with. So instead, there's talk about relying on 401.5 to establish a secondary market, both for private companies and for thinly traded public companies who do private placements or have a lot of venture capital or other affiliated type investors. Problem with 401.5 is no one really knows what the conditions are, what the requirements are. If you're going to apply the private offering concept to resales by investors, the private offering concept you have to apply are the 4A2 private offering exemption. Reg D, the safe harbor, is only applicable to issuer offerings, not to resales. The concepts developed by the courts under the statutory private offering exemption are very vague and very onerous. That's why we have Reg D in the issuer context to clarify some of the concepts and to take away some of the onerous interpretations by the courts. For example, the courts generally viewed a private offering to have a limited number of offerees. The advantage of Reg D was supposed to make it unlimited number of offerees. The courts had vague notions of being able to, sophisticated investors able to fend for themselves. The SEC and Reg D codified the credit investor standard, but who knows what the standard is in the 4.2 area, and as would apply in a 401.5. The ability to get information equivalent to a registration statement. Well, that doesn't even apply for Reg D offerings to accredited investors. But what's that standard outside of Reg D? What information has to be provided? So it's hard to give opinions on 401.5 because those standards are very vague. And that may be part of the reason that you haven't seen active exchange-type markets develop in private company securities or some of these OTC markets because of that difficulty of giving advice, as well as issuer restraints on transfer of ownership of those type of securities.
The future for legislation in the area of the Jobs Act, as well as other issues impacting small capital formation and emerging growth companies. David Burton is the Senior Fellow in Economic Policy at the Heritage Foundation, where he focuses on tax matters, securities law, entitlements, regulatory and administrative law. David was general counsel at the National Small Business Association for 2 years before joining Heritage's Rowe Institute for Economic Policy Studies in 2013. He previously was chief financial officer and general counsel of the startup Alliance for Retirement Prosperity, a conservative alternative to the AARP. For 15 years, David was a partner in the Argus Group, a Virginia-based law, public policy, and government relations forum. His career in financial and tax matters also includes the posts of vice president for finance and general counsel of New England Machinery, a multinational manufacturer of packaging equipment and testing instruments, and manager of the U.S. Chamber of Commerce's Tax Policy Center. David?
Glad to be here. I'll try not to be too long and keep us all away from the libations. The 2012 Jobs Act was a bipartisan achievement of consequence, particularly rare, and the members of Congress overcame their partisan differences and took steps to substantially improve the regulatory environment for entrepreneurial capital formation. It was a reminder that important steps can be taken in the public interest, but I think that at this point, some of that bipartisanship has declined, and the bipartisanship that permeated the effort to pass the Jobs Act is now more strained. There's a lot to be done to improve the regulator's implementation of the Jobs Act. I think most of the people in this room follow that fairly carefully, but the rules are not what we had hoped. They may yet, if they ever come out, prove to be better. But some of the rules, particularly and most notably the Title III rules, are nearly 2 years late at this point, which is late even by the SEC standards, particularly in something that had such broad bipartisan support. The bottom line is I'm not sure we can expect the SEC, based on their recent record, to do anything terribly constructive in this space on their own initiative. And I think for those of us trying to improve the regulatory environment for entrepreneurs, startups, and small businesses, we're going to have to look to Congress. Now, this is one of the relatively few areas where we have a genuine opportunity to achieve bipartisan consensus, or at least a willingness to work across the aisle. But that tends to be, or at least so far, primarily a House phenomenon. As most of you know, the House Financial Services Committee passed a series of over 20 bills, all of which the Senate ignored. That is going to change. With the new Senate, we know that a lot of the kinds of legislation that the House has been passing will be more seriously considered and probably pass in some form. We also know that we probably can take bigger steps because most of those pieces of legislation were relatively discreet in terms of what they did. So we have an opportunity, and it's not just this Congress, but because although the president may sign some of the legislation that's passed by Congress, it may veto others, and it may take another administration. This administration has been willing to look at these issues, but it hasn't been engaged, really, and that would include the White House and also the SBA and other parts of the administration that should care about this. So we may get some things done in the next Congress, and we may have to wait, in some cases, for the Congress after that. But in the aggregate, I think we have an extraordinarily rare opportunity to fix this